So let's talk about some Fed stuff. Against this backdrop of some risks in the US economy, we've had very hawkish Fed forecasts, something called forward guidance. There's a list of forecasts here. These represent what the Fed has consistently said would be the forecast expected by its members. So once a quarter, the FOMC, the members themselves on the Fed, they put in forecasts on what they expect the interest rate will be in the future. So in September of 2014, these forecasts all represent one thing: the end of 2016 forecast. What Fed members expected the rate would be in just a few weeks. And back in September of 14, they expected that rate would be 2.68%, right? Now maybe we're going to get a rate hike this month in December, and it looks like the most recent jobs report has paved way for that, right? We've seen a drop in the unemployment rate. We've seen consistent improvements in the labor market. The labor force participation rate's still low, but we've seen a lot of improvements. And the Fed funds rate is probably pretty close to what's called the neutral rate. In other words, the Fed isn't being too accommodative at this point, but they also might need to think about raising rates. Despite that fact, 2 years ago, they said that it would be at 2.68 at the end of this month. We're nowhere near that, right? That the back end of the yield curve has just gone over that in just the last couple of weeks. And that forecast was lowered at 8 consecutive Fed meetings, right? They have these once a quarter. They bring in the forecast. So that's quite a bit low. Even right now, they're expecting the end rate for next year to be 131 and the end rate for 2018 to be 211. Only now with the prospect of additional fiscal policy stimulus do I see a risk of the end of 2018 number coming true. I still think the 2017 number might be too high because there are some risks at the front end of the year. While there is hope of tax cuts and spending, companies are going to hold back. Well, Janet Yellen's commented on these forecasts, and the Fed has communicated a lot more in recent years, right? If we were to look back in time, you'd see in 2004, the Fed statement was a couple paragraphs. There were no forecasts. There were no press conferences, nothing like that, right? But Yellen's take on the forecast now and on what's called the dot plot, which shows where all the different Fed members might be forecasting, based on this quote from the speech she gave in Jackson Hole at the end of August, is that our ability to predict how the Fed funds rate will evolve over time is quite limited. Right? Not a very inspiring statement. You know, right? I mean, I would tell you about a speech I saw Ben Bernanke give in 2014. Now, I'm lucky. I've known some folks in the Fed for a long time, and I get invited. I've known Dennis Lockhart, president of the Atlanta Fed, for a decade now, and I get invited every year to an event where they invite 100 economists. Often the Fed chair spoke and has spoken in the past. Different Fed presidents are there. So there might be 125 people, and 4 or 5 of them might be Fed presidents, right? It's a really good group. And a couple of years ago, Ben Bernanke gave a speech before quantitative easing ended. It was in the early part of 2014. And the question was asked, what's the Fed's plan for ending quantitative easing, right? So it's a room of 100 economists and very senior Fed people. And his answer was, you know, our plan is trial and error. And, you know, kind of all the economists at my table kind of gasping. You know, I'm surprised people didn't faint, right? And he goes, you know, just kidding, but, you know, honestly, kind of not, right? You know, kind of, just kidding, right? And so, and then he said that the plan was to kind of slow it and then eventually raise rates. And someday, maybe in the future, maybe, the Fed would consider rolling things off the balance sheet. I think they're going to hold most things to expiry. This is a very long and slow process. I mean, at that time, they expected the Fed funds rate would be, you know, closer to 3% right now than 1%, right? So this is very, very interesting. The second thing I'd point out is, even though people have had a very hawkish view on the Fed, and I think they will raise rates here, but I think it's going to be very slow, are 2 things Janet Yellen also said when she was at Jackson Hole. And the first is, I expect that forward guidance and asset purchases will remain important components of the Fed's policy toolkit. What this means is the Fed's going to buy more stuff in the future, right? This expanding the Fed balance sheet, quantitative easing thing is not a one-time deal. They're going to do it more. They're going to do it again. And she also noted future policymakers may wish to explore the possibility of purchasing a broader range of assets. In other words, not only are they going to do it again, but they're going to buy other stuff. To give you some idea what this other stuff could be, right? The European Central Bank has been buying in the bond market. If you look at the Bank of Japan, there are reports from the Financial Times, a number of reports were done this summer that analyzed and showed that by this time next year, you would see the Bank of Japan owning 20% of some publicly traded companies, right? So equities, bonds, who knows? Going to buy other stuff next time, right? So even though you might think of this as hawkish, you know, I would probably view this with the same skepticism as my wife is actually viewing these real hawks, as opposed to the Fed hawks, which have not been hawkish at all. You know, very skeptical, right? This is actually quite dovish in the long run because the Fed's going to be buying crazy stuff going forward. Now, despite what could happen in the future, what we've seen for the dollar is that it's risen. This is a monthly chart of the greenback. There's a couple of moving averages and levels here, but the important part is we are here on the right, and these are levels, that blue line there, that was a range we'd been in since early 2015. We recently broke out of that range, and if we look back, that's the highest level we've been at recently in about 13 years. So you've seen a lot of dollar strength. The second thing I'd say, though, is that for almost 2 years, we were in a pretty narrow range. So even though we've recently broken out of the top of the range, you know, we've been somewhere kind of narrow. Now, if the Fed does raise rates, I think you're going to see the dollar go a bit higher here in the short term. But the truth is that if we see more deficit spending and we see more tax cuts, what you're going to see is the budget getting bigger and bigger, and that could eventually weigh on the dollar. So this is something I'd be looking for in the sort of 12 to 24-month window, is even though the Fed might be raising rates, the impact on the dollar could be a bit mixed because they're raising rates not necessarily just because you see improvements in growth. In the same way that the back end of the yield curve isn't up because the expectation is you're going to see significantly higher growth for the next 30 years. The back of the yield curve's up because guys want out of bond markets because interest rates are going to go up very sharply in the immediate term.